Okay, exercise 18-22B. So here we've got a sales transaction where we've got Upper World Corporation, who's apparently a manufacturer of tractor trailers, and they sell these tractor trailers on an installment basis. So on October 1st of 2014, they sold one of these tractor trailers to a company. And the contract stipulated that there would be 5 payments of $250,000 made from the from the buyer to the seller under this contract. The first payment of $250,000 would take place today on October 1st, 2014. That's the day of the sale. And then the remaining 4 payments of $250,000 would be made October 1st of each of the succeeding years, 2015 through 2018. Now, the question is, well, okay, so let's look at the additional facts. So, factoid 1 tells us that the amount that would be realized on a sale of this trailer for cash, if somebody wanted to come along and pay cash, would be $965,000. Okay, so the question is, why would somebody, the buyer, be willing to make, let's see, 250 times, that's the payment amount, times 5 payments. Why would they be willing to pay $1,250,000 for something that if another customer came along with cash today, that customer could buy for $965,000? Well, the answer is that additional payment that the buyer is making above and beyond the fair market value of the trailer is essentially a financing cost. And so that difference, $1,250,000 as compared to the fair market value of the trailer, that difference of $285,000, we're told here in factoid 3, is basically interest that the buyer is paying to the seller for the right to make payment over this 5-year span of time. Okay, so what GAAP requires that we do? GAAP requires that we measure the amount of this receivable not at its gross amount. Its gross amount is $1,250,000. Rather, we measure that receivable based upon the present value of the future payments that are required under the receivable, using, in this case, an effective rate of 14.9%. Now, what that 14.9% is, obviously it's provided to you in the facts of the problem. But what that is that's the present value, which when used to discount those future payments yields a present value equal to the fair market value of the trailer of $965,000. In other words, discount these future payments at 14.9%, and with rounding difference you come up with $965,000. Okay, so what we're going to do is we're going to book the receivable, the installment sales receivable here, at an amount that is equal to the present value of these future payments that are required under the lease, under the terms of the installment obligation, which is $965,000. The offset to this installment sales receivable is going to be the amount of sales revenue that we're going to recognize. In other words, we recognize the sales revenue based upon the present value of the future payments that are required to be made under the installment agreement. And then we recognize cost of sales based upon the cost of the trailer to the cost of the trailer to the manufacturer here, which is $786,000, and remove the cost of the trailer from the inventory account. Okay, so this is the entry that the seller of the trailer would make on October 1st, 2014 to book the sale. Again, the installment receivable and the amount of the sales is not based upon the gross payments required under the installment agreement, but rather based upon the discount or present value of those installment payments. Okay, so then at the end of the year on December 31st, 2014, what's going to happen? Oops, sorry, there's one other thing I left out before we get to the end of the year installment receivable. I need to insert a row here. Okay, we need to book the receipt of the cash here. On the day that we entered into the sales agreement, yes, this is the journal entry that we made, but we also received cash. We received $250,000 of cash that we need to book. Debit cash $250,000. Credit installment receivable $250,000. Okay. So roll forward to December 31st, 2014. At December 31st, 2014, we of course are preparing our year-end adjusting journal entries, and we need to accrue the interest that is due on this note. So the journal entry, debit interest receivable, credit interest revenue, and the amount that we're going to book this entry for is calculated by taking the carrying amount of the note, or the carrying amount of the installment receivable at the beginning of the interest accrual period. Now the interest accrual period, because the sale took place on October 1st, 2014, and we're standing here at December 31st, 2014, we've got October, November, December, we've got a 3-month interest accrual period. So what we've got to do is we've got to take the carrying amount of the installment obligation, beginning of the interest accrual period, that's $965,000. The amount that we booked here, the amount that we booked there as a debit, and we need to subtract from that the cash that we collected here of $250,000. That gives us our carrying amount of the note at the beginning, of the interest accrual period. And then we need to multiply that $715,000 times the interest rate. And we said that the interest rate here, the facts of the problem tell us to use an interest rate of 14.9%. Carrying amount of the obligation beginning of the period times the stated interest rate. Now that gives us the interest rate for a full 12 months. However, we need to only accrue interest for 3 months, right? So we're going to multiply that times 3/12 of a year. And so the amount of interest then that we need to accrue through this adjusting journal entry is $26,634. $26,634. I rounded here on the adjusting journal entry. So basically what you have here is an example of a sale that has embedded in it implicit interest. There is no explicitly stated interest, but implicitly there's embedded interest in this transaction because we're paying back more than the fair value of what we bought. So what we do is we impute interest, come up with the effective interest rate, which causes the present value of the future payments to equal to the fair market value of what was sold, recognize sales revenue based upon the present value of those, book the receivable based upon the present value of those future payments, and then at the end of each accounting period, accrue interest, recognize interest that's associated on the obligation.